waiting too long, right?
Just depends on how many questions they have.
No, but I was saying y'all weren't waiting on us at all, were you?
A little bit. I don't know.
I never got an email saying it was, so I just came up.
They didn't tell you it was at 2?
You told me it was at 2, but I was told it was going to be a time adjournment. I thought that it could be my
Listen.
if there's ever something wrong, I'll just take it.
Let's see. All right, we got everybody here. Okay, everybody. I think we have some folks. I know everybody's got a busy schedule. We've got members who have other committee meetings, so we'll go ahead and get started. Representative Donahue, if you'll open us up with a word of prayer. Okay, thank you.
Let's pray. Heavenly Father, we lift you up and praise your name. We thank you for the opportunity today. We pray that you do with families, that you watch over them as we're away. Lord, give us safety and knowledge. Help us to make proper decisions best for each person involved here today. In Jesus' name we pray. Amen.
Thanks, sir. We're here today for a hearing only on Senate Bill 283, Senator John F. Kennedy's bill, our friend from the Senate from the 18th. And I'm going to ask him to come to the podium and explain his bill, and then we'll have, if there are any questions for the senator.
Good afternoon, and thank you, Mr. Chairman, and thank you to the members of the committee for giving me an opportunity to speak to Senate Bill 283. It is an important piece of legislation, I think, proposed legislation, and for reasons that I'll speak to in a moment, also very timely that we take it up. This bill addresses somewhat of a unique relationship that banks have with public depositors, those being from the city, county, public school boards, or universities, such that when a bank accepts a deposit from a governmental entity such as that, the bank is required to pledge 110% of the deposit less the $250,000 FDIC insurance as provided through the FDIC. The collateral is pledged in the form of highly liquid assets such as U.S. Treasury bonds or Georgia municipal bonds. There are two ways that mechanistically the collateralization process works for the government deposits. The first is the direct pledge method, and that's where the bank pledges the collateral to the governmental depositor one by one, and the depositor themselves oversee the compliance of that collateral. The other way is for a bank-level pooled method, and that's where the bank pledges the collateral to the state treasurer in an amount equal to all their governmental deposits, less again the $250,000 FDIC insurance that's provided, and the state treasurer, rather than the depositor, oversees compliance on behalf of the depositors. Only governmental deposits are collateralized in the way that I've just described. Deposits from you and I as individuals and businesses are not collateralized this way. The problem is that for some time now, banks have had substantially more deposits than they have been able to deploy in the form of loans. Because of the collateralization requirements, government deposits are more expensive and require more compliance than do other such private type deposits from individuals or businesses. Recently, and this is what has made this problem acute, the U.S. has adopted some new international rules on capital and liquidity, referred to as Basel III, that have made it extremely difficult for larger banks to effectively support the collateralization needs under the scheme that I've described required for governmental deposits. In addition to the 110% collateral required, as I've described as currently required, banks also, under these new regulations, have to set aside collateral up to an additional 40% on top of the 110% that's already there under these federal rules, thereby making the total collateral set aside up to 150%. The problem is, from the governmental depositor standpoint, is that we've heard from a number of such depositors that because of these additional collateralization requirements, sometimes they're having, quite frankly, a hard time in finding a bank that will accept their deposit. This has also created problems for these public institutions in that some of these institutions, municipalities, for example, that may have a requirement for, under their own ordinances, that they get 2 bids before they enter into a banking relationship. Sometimes they're finding that only one bank will bid the business, so to speak. So that's creating some internal problems for our public institutions. It's not because the banks don't want to do business with the governmental depositors. It's just simply that the rules that are in place, in particular these new rules that went into place January 1, some 45 days ago, have changed to the point while other banks simply can't put the deposits to work as is ordinarily done under the normal banking model. So that's the problem. What is the solution? The solution is, and I've told you about the 2 ways that banks collateral, or that public deposits are collateralized in the form of the direct pledge method and the bank level pooled method. The third way that's being proposed by this bill, which is new, is called a multi-bank contingent liability collateralization pool. That is a third governmental deposit collateralization, very similar to what some of the states around us have done, including Florida, Alabama, Tennessee, and Virginia. As the name implies, there will be multiple banks that are participating, and in particular, the statute calls for the 10 largest banks doing business in Georgia to participate, and they are required to participate. Importantly, I'll footnote there that the 10 banks that are required to participate are fine with this. The state treasurer will then monitor the collateralization both at the bank level and the pool level. All banks participating in the program will guarantee the government deposits of any one bank against the unlimited losses caused by the failure of any participating bank. I'd like to say that again and emphasize, because that really is a key to why this works and why public depositors are seeing and are having a good comfort level with this new model that's being proposed. Unlike the current model, where a public depositor can only look to that one institution and the collateral that's been pledged, under the multi-bank pool method, all banks participating in the program, which will be a minimum of the 10 largest banks in the state of Georgia, will guarantee that the depositors of any one bank against the unlimited losses caused by the failure of any participating bank. Because of that unlimited guarantee against losses, the role of collateral is less important, so the banks can qualify for a reduced percentage of collateral. As you'll read in the proposed legislation, there's a sliding scale of a collateralization requirement of 25% at a minimum up to 125% maximum based upon the health of the bank. So, how does it work when the rubber hits the road? The State Depository Board will oversee the program for the state of Georgia. They will come up with the operating procedures and approve the banks that will be eligible to participate. The state treasurer and the commissioner of the Department of Banking and Finance will be responsible for the day-to-day activities of the new pool. To diversify the risk, the bill requires that the largest banks to participate, and they have all agreed to do that, as I stated just a moment ago. Other banks, smaller banks if you will also be able to participate in this multi-bank contingent liability pool, but they can do so on a voluntary basis. They're not required to participate. They can if they're eligible. The participating banks in the program will pay for the administration similar to how they're paying for the administration of the bank pool level now, and that's important to us for 2 reasons. One, there will be no direct costs to the state of Georgia for this, and 2, no additional staff will be needed at the state treasurer or the banking department's office to oversee this multi-bank pool. In order to get the policies and procedures in place, the proposed legislation gives everyone until July 1 of 2017 to complete their work that they need for the ramp-up. Finally, and I think this is important and very telling, those that are most affected by this are all, Mr. Chairman and members of the committee, all in favor of this. The state treasurer, Mr. Steve McCoy, who is here today, representing the state, if you will, from that perspective, is in favor and also worked significantly on this. The banking commissioner, Kevin Hagler, the commissioner of the Department of Banking and Finance, he too is here. He also is in favor of this. As are perhaps maybe the question in your mind, what about the folks that own the public deposits? Well, they're in favor. I'm happy to report to you that the ACCG and the GMA support this solution, as do the banks. I'd like to thank Mr. Joe Brannon and his work and compliment Mr. Brannon for in their work last year, calendar 2015, realizing that this problem was coming. I think really did yeoman's work in getting a lot of input from a lot of different stakeholders from different perspectives and different interests to come together and conclude with a solution that I think is very workable and is something that we definitely need. And I appreciate the time to present this. I'm happy to answer any questions, or I've got the smart guys at the back of the row, Mr. Chairman, that can probably help if we need their help. Thank you.
No, they're probably way too shy back there. Okay, does anybody have any questions? Any members have any questions for Senator Kennedy? This is it's a very important piece of legislation. I saw it as such, and I wanted us to have a hearing on it, and so that all the members would have a chance to be involved in this bill. It's very important. You would be 5, I believe. Representative Williamson.
Thank you, Mr. Chairman. Thank you, Senator, for bringing this measure. Is it not true that this also plugs an exposure, a current exposure in the existing methodology for our local public depositors? Let me give you an example. Is it not true that a local school board might have a depository relationship with a local bank, and then all of a sudden, and the local bank has appropriately collateralized the current amount of deposits at 110%, but then all of a sudden an influx of cash comes in from let's say the local school board, that goes over the amount that's at that point in time collateralized. It could be from tax funds coming in, or tax anticipation note that the school boards use to pre-fund their account in anticipation of the tax revenues coming in, or something similar like that. But all of a sudden, there's a big exposure for the school board that has to be. I believe that the current law mandates 10 days for the depository institution to get that liability covered. So, is it not true that this methodology would eliminate that exposure for our local public funds?
Yes, Representative Williamson, thank you, and I appreciate that question, and it does do that for the reasons that you've really articulated, where that window of opportunity that could be an exposure to the depositor would not exist here. And that also, I think, is a good way to use to amplify how the multi-bank pool, because you're spreading it out and you have more people, more banks, if you will, that are responsible rather than a one-for-one, I think it ultimately means less risk for the depositor overall. Thank you.
Any other members have any questions for Senator Kennedy? No other questions? One, yes. What number? Let me try this.
I'm not sure.
Give it a try.
Thank you, Mr. Chairman. I just have one question. Looking at the asset number that we have at $50 billion, which is an exquisitely significant amount of money. Could you explain, I see the bank's pooling method. Can you give me an example of what two entities would actually partner for an amount of money of this magnitude?
I'm not sure I understand the question, Representative.
I was reading it. Daily pool balance means the daily balance of deposits of public funds held by a depository, which means balance is secured by the single bank pool method as specified in paragraph 2 of the subsection, or the multi-bank pool method. Could you give me an example of a multi-bank pooling method when we're talking about $50 billion or an amount up to and above that? I think it's lines 50 through 54.
Yes, sir. Okay.
Just an example so I can see exactly what entities would actually be pooling these assets and resources?
Well, the $50 billion figure, I'm looking for that, Representative, in, where did you, what line is that on? I want to make sure I'm with you.
That's line 23 on the front. Any depository whose total assets
Right.
exceed $50 billion as of the latest consolidated report of condition.
Yeah, yes, sir. That threshold is being used to determine the 10 largest banks that operate in the state of Georgia, and those happen to be 50 billion and more. And it is that threshold that creates this number of 10 banks that I've alluded to in my remarks earlier.
Thank you, Representative. Are there any other questions? No, we didn't have a sign-up sheet. Thank you, Senator Kennedy. Okay, there was one. Did anybody sign to speak on the bill?
No, sir.
Nobody signed? Okay. Did everybody know there was one? If there's not any, you can certainly speak. Not that we doubt the integrity of the senator. I'm sure everybody's for it, but if anybody wants to speak in favor of opposition to the bill, we'll be happy to hear it. None? Okay, Senator, thank you, and we'll get back with you. We'll try to get together full committee for a vote before this week is out.
Yes, sir.
That's
Thank you,
our
Mr.
intention.
Chairman, and thank you to the members of the committee.
Thank you, members and guests. Thank you. Thanks.
This is not a full committee, this is a subcommittee.
No, it's full committee, but there's committees going on everywhere. Right.